percent, while at the same time saying that the housing market is facing significant challenges. So, Josh, what are your thoughts?
When you said it's showtime, I was like, that's Fed Day, right? We wait around for the 8 days a year when we get to hear the oracle come down from the mountain and tell us how the economy is doing, what inflation looks like, and what that's going to mean for all of us moving forward.
Exactly what's going to happen. So, I mean, the big news is the Fed did cut rates. It was kind of in question up until a couple of weeks ago. I mean, even then, a little bit in question, but was confirmed today. So we did get that 25 basis point cut. But I think the remarks after the initial cut were probably some of the most important things that have been said in some time when it comes to housing, Josh, because a lot of people think, hey, listen, the Fed should do this. It's going to help the housing market out. The Fed should do that, because it's going to impact affordability. And essentially what Powell came out and said is, listen, there's little to nothing that we can actually do to impact the housing market and affordability. And we're going to talk about it today as we go through those slides.
We're going to talk about it, but the thing that struck me when he said that is we know that he and the president have been at odds for the better part of a year, even though he was nominated during Trump's first term. This is a way to really combat, like Trump has been saying, stupid Jerome Powell is killing homebuyers by keeping rates higher than they need to be. And he came out and basically said the issues are bigger than the Fed, number one, and outside of the scope of what we do. So you want to take a look, and we'll see exactly what that quote was.
Yeah. So, we always like to start these videos by talking about, just what's happening out there in the economy. And the big thing today is the PAL. So the PAL, the big news is the Fed rate cut. But what Powell said the housing market faces really significant challenges. And I don't know that a 25 basis point decline in the federal funds rate is going to make much of a difference. Housing supply is low. We haven't built enough housing for a long time. We don't really have the tools to address a structural housing shortage. And then they go on to say a couple of other just statements there that were made was housing supply is low and we haven't built enough housing for a long time. Many people have very low mortgage rates, making it expensive to move. A 25 basis point rate cut isn't going to make much of a difference for affordability. So again, I mean, you said there, a candid acknowledgement from the chair, and it's something that he typically doesn't get into. So it's a big statement for the housing market in general.
This is one of those things where both pieces of it are true. And it's funny, in the comments section on our videos, on the podcast, on your channel, and you get people saying this is stupid. Why are you talking about interest rates? Interest rates don't change anything. Well, interest rates are significantly lower than they were a year ago. Purchase applications are significantly higher. Refinance volume is double what it was. So Powell here says a 25 basis point decline in the federal funds rate isn't going to make much of a difference. Well, we've had a 75 basis cut. Was it 75 or 100? I think we had 100 of total cuts last year, 75 of this year. Yep. So one of his comments was that we are in the range of neutral. There is a range of estimates of what expert economists think the neutral federal funds rate is. And he says, we have now cut that we're within that range of what most experts believe. So we've taken away, we're not adding stimulus, but we've taken away the foot on the brake for now. And it has improved housing, but all of those structural problems that he's talking about, the issues with affordability, the fact that we overstimulated the economy and overstimulated home prices, that now we're in a situation where we have haves and have-nots, and even the haves feel stuck in what they currently have and they're not able to be mobile. All of that is a negative for the economy as a whole. Forget just housing. We want people to be mobile, especially young people. We want to be able to move around the country, go to wherever the opportunity is best, build their life, build their fortune if that's how it plays out for them. And we are sort of taking away those options. So it was absolutely interesting to me that he chose to address it directly today.
Yeah, and good stuff. And with that, Josh, we saw the 10-year. What did the 10-year do when the announcement was made?
Yeah, so we always like to show this chart because this is a 15-minute chart, and there at the beginning of the announcement, you saw that rates had dipped. We started about 420 on the 10-year, and it looks like we got down towards the 410 range on that long wick at the bottom of the candle. And then as we get towards the press conference, the market always gets wary, especially after the last couple of press conferences where we got what was truly a hawkish cut. We cut rates, and then he comes out and basically says, hey, economy's doing great. Don't expect a lot of cuts, a lot of dissent, a lot of discussion. We don't know what we're doing next. So the fact that we only ran up 3-4 basis points once that press conference started and then went back down to the lows of the day and ended not at the lows, but closer to the lows. This is good to see because the last couple of meetings we've seen the opposite, where he takes the stage and by the time he's done, we're on the highs of the day and don't really look back for a while. So definitely the way the market reacted, it took it. They were expecting a hawkish cut. The hikes or the increases we've seen to yields in both mortgages and 10-year over the last 2-3 days, largely just people preparing for that hawkish cut and him to basically deliver the same speech he did the last 2 times. And we didn't get that. It wasn't super bullish or dovish where he's saying, hey, everything's great, we're going to cut 10 more times next year. But he didn't exactly take away the punch bowl the way he does the last couple of meetings.
So the Fed has a dual mandate: price stability and maximize or maximum employment, if you will. So with that, inflation is obviously a big component of what drives the Fed to make decisions, whether it's hiking the Fed funds rate, keeping it the same, lowering it, what have you. And with that, there was a couple of comments on inflation. So Josh, want to read those?
Yeah, they're good. He said inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated. Goods inflation has picked up, reflecting the effects of tariffs. Services disinflation appears to be continuing. So basically, he dismisses the inflation that we've seen as being limited to goods and due to the tariffs, and we're seeing disinflation in services, largely housing. And then we see tariff-driven inflation is likely to be a one-time price level increase. If you get away from tariffs, inflation is in the low 2s. So why are they comfortable cutting when inflation is almost 50% higher than where they want it to be? Because they're looking to where the puck is going, not where it is today. Our obligation is to make sure a one-time price increase does not become ongoing inflation. So we have some views of this here in the chart. So if we look at this, this is the Cleveland Fed. They're nowcast, and you guys that are here every week and have seen this chart before know we usually only have 2 rows here. Well, today we have 3 because we're backed up on data because of the government shortage. So October is forecasted to be nice and low. November and December are going to be a little bit higher, and these forecasts are pretty darn accurate, pretty good. So if you see on CPI, we're looking at going on the core from 2.99 in October, 2.96 in November, 2.99 in December, and PCE 276, 288, 293. So if you look at those numbers, we're not moving in the right direction, but they are looking at underlying data and realizing that once we get a few more months down the line, we should see some moderation as those one-time price increases due to the tariffs have filtered their way through the economy. We always like to look at trueflation. This has leveled off. We were at much lower levels where trueflation was telling us we were actually in real time near that 2%. It got up as high as 2.65 or so, and we're down to about 2.5. I thought this was really important, Jeb. We come off the holiday season every year. Black Friday hits, Cyber Monday, and you see on the financial news, they're talking about what did retail sales look like? And every year, hey, the consumer's doing great. Look at what retail sales looks like. That orange line keeps showing they're buying more and more stuff. Well, the blue line here is normalized.
You don't have it on the screen there, Josh. There we go.
I'm sitting here at the one that I can see big here, Jeb, and I'm not moving the slides forward. It would be helpful for those of you watching at home to see the actual chart. But the orange one there is showing what actual retail sales have done. And if you look, the important part about this chart is the blue and the orange lines moved together until about January of 2021. That's when inflation took off. And since that time, real sales, so sales adjusted for inflation, have just been sideways. People aren't buying any more of anything than they were 3 years ago, but the prices they're paying for it are more. So from that perspective, inflation is sort of skewing the data and what people are thinking about a robust consumer. So as you mentioned, Jeb, the other one here is employment of that dual mandate. They weighed in on this. Powell says we think job gains are overstated by about 60,000 per month. If that's true, job creation could already be negative. Unemployment has edged up. Job gains have slowed significantly. surveys showing declining demand and declining supply of workers. We always talk about supply and demand here. It's a problem if they get out of whack. They're moving together, so we're not seeing inflation spike. We're not seeing unemployment spike because there's less demand for labor, but less supply of labor, whether that's due to the immigration issues, whether it's due to baby boomers retiring. Not exactly sure what that is, but downside risks to employment appear to have risen. We expect the labor market to stabilize, perhaps tick up 1 or 2 more tenths, but not a sharp downturn. I don't know about you, Jeb, but when I looked at that, the thought that came to my mind is we saw that happen in 2007, 2008. Not that the economies are anywhere near the same, but we saw Greenspan at that time. Was it Greenspan, or we already shifted over to Bernanke? Whoever the Fed chair was at that time was basically saying the same things. Maybe a couple more ticks, but we're not going to see it get out of hand. So it is a very different economy. I don't think we're going to see double-digit unemployment, but it'll be interesting to see if they're correct. If we come back next December and we're still under 5% on unemployment and we get inflation down near 2%, then they've pretty much threaded the needle exactly the way they hoped and wanted to. And that's what Powell's hoping for his legacy. Sort of the thing to leave us with, where they said our policy stance. What are we looking at? What are we thinking of moving forward? We're well positioned to determine the extent and timing of additional adjustments. And as we said earlier, the Fed funds rate is now within a broad range of estimates of neutral. So they think they're neutral, and they're hoping that things have stabilized and there won't be any need for cuts. He did come out and say, hey, we're not really considering hikes at all at this point in time. So flat to down over the next part of the year. And what does the Fed funds futures market think of that? Right now, the next meeting is in January. They're predicting 78% chance nothing happens. And then we start getting there at the next 3 meetings, a greater probability of another 25 basis points, and then another 25 basis points somewhere in the second half of the year. So the talking heads on CNBC, Jeb, we're talking about 1 cut next year based off of what the Fed was saying. And then by the end of the day, Fed funds futures market has 2 priced in. So we're somewhere near neutral. Rates not likely to be going up, could be improving over time.
Good stuff. So we always talk about supply and demand here because that's essentially what drives markets. This week we saw inventory decline from just over 817,000 homes nationwide to 795,000 homes. So decent sized drop there, pretty typical for this time of year. Inventory will continue moving down. We're still just over 15% more inventory right now than we were this time last year. Not really much to concern yourself with. I mean, again, seasonality is starting to play a big part. One of my mentors, somebody that I follow closely with housing data, seems to think that 2026 is going to look a lot like 2019, a more normal market. You're going to have seasonality. You're going to have a spring selling season. You're going to have a little bit of push in the summer, and then you're going to have a push towards the end of the year, like you do essentially every year. So it looks, if that ends up being true, that'll be a lot of opportunities out there for buyers, which, definitely a good thing. We like to look at inventory here, both in Orange County and Huntington Beach, because that's where we're located. Remember, real estate is local. So here in Orange County, inventory is now at 3,479 homes. These charts are aggregated by us. So we don't have, we just started keeping track of the actual data 3 years ago, even though we been following it for a much longer time. So as we continue to go through this, these charts will get more and more significant. But you can see pretty typical for this time of year for Orange County, down 4.28% week over week. Huntington Beach, sitting at 224 homes, down 1.79% week over week. Again, not much to concern yourself with. Pretty normal. Pending home sales declining. It's seasonality. It's that time of the year. Just less people out there shopping. Not going to go through these in great detail. Percentage of homes with some sort of price cut, whether it's $1, whether it's 5%, 10%, right? They're all price cuts. But sitting at 40% of the market at the moment have some sort of price cut on the actual listing there. So again, if you're a seller and you're serious about selling your home this year, price cuts are probably necessary, right? And you only got a couple weeks left in 2025. Chances are, if you're buying a house now, you're probably closing in 2026. So pretty crazy stuff that the year has absolutely flown by.
Jeb, the problem was we
Yeah.
were saying that in like February and March, that it's amazing. It's already February. It's amazing. It's already Easter. And then you're like, it's all over. It's all over with the crying.
It is. So existing homes, months of supply, sitting pretty normal when you look back historically, kind of in that middle gray area there, 4.4 months of supply nationwide. That's pretty good. It's still, it's a balanced market in a lot of markets. Some markets still favor sellers, but there's also some markets out there that are favoring buyers as well. And I think this trend continues probably through February, and at least until you start to get some more supply to the market. And a lot of what happens at that point will be dictated by what happens with interest rates between now and then. Delinquencies, a lot of people want to focus on delinquencies. You see the headlines, hey, delinquencies are up, so on and so forth. Look, I mean, you can see from the chart here, we're below the average. I can't tell on that chart, Josh, how far that goes back on your big teleprompter there. How far does that chart actually go back there?
2004.
2004. So you can see 3.54% or so, where the national average is like 4.4 something during that time. So again, distress is low in the system at the moment. Don't expect, big price cuts, big foreclosures, what have you. This is taking a look at Fannie Mae's REO inventory. You can see it from here. Next to nothing in the grand scheme of things. So anybody comparing what's happening now to 2008 clearly doesn't follow the data. And you can check it out just looking at that chart. Shift in home prices, Josh. This came from Resi Club. Most, depending on what you're following out there, annually, comparing last year to this year, I think home prices are ranging somewhere between just over even to probably 1.5%, somewhere in that ballpark for most markets out there. So looks like we're probably going to stay above that neutral point for the remainder of 2025. Early part of 2026, depending on what happens, you might see a little bit dip in home prices, but I believe the bottom is probably in for a lot of markets out there as rates continue to move sideways to down and more people come off the sidelines. So with that, Mr. Lewis, yep.
Well, just on that last chart, what I was going to say is what I was most surprised by was 23 and 24 seeing as much appreciation as they did. It wasn't a ton, but 3 to 5% depending on the market. I would have expected 0 to 2% for 3, 4, 5 years. So a little unhealthy that we got as much as we did those 2 years. So it wouldn't be out of the norm to expect several flattish years. And as we've said a million times on the show, if inflation's 2 to 3% and homes go up 1 to 2%, in real terms, they are actually deflating in terms of prices.
Sure. No, absolutely. And that's why we talk about having a longer term time horizon as well, just in case you are planning on buying, looking a little bit further out in the future for the type of property that you're trying to buy, so that you can stay in it for that period of time. Because again, if home prices move sideways in a lot of markets out there and you put a smaller down payment, there's a chance you could be upside down on equity when it comes time to sell it. So you just want to prepare and plan and make sure you're ahead of that, so there's no issues there. What are we looking at here, Josh?
We went through most of the Fed stuff early here, but I wanted to just throw this chart in here. This is Treasury debt. We just topped $30 trillion of Treasury debt. So we also have off-balance sheet debt, unfunded liabilities for Social Security and Medicare, but 30 trillion here that we can see that the U.S. government owes. And there was a spike up here in 2020 as we had all sorts of programs and spending during COVID. But the thing that strikes me about this, Jeb, from 2005, it was the left side of that, through 2025, 20 years, we've had Republican presidents, we've had Democratic presidents, we've had Republican House, Republican Senate, Democrat House, Democrat Senate, but that line looks really similar no matter who we elect. Yet the funny part is if you go online, whoever's in office, we have the other side going, see, those idiots just keep spending. But the uniform switch, and then whoever's complaining and whoever's grandstanding, like we really need to tell these people, we have to get serious about this right now.
You tell them. You should write them a letter.
Well, I should. They won't listen, but we as a collective should rise up and be loud enough to say, this is absurd that you guys want to divide us and say, point fingers at the other side. The other side.
We should invite them on the show.
We should. We're gonna write our congressman. Would you like to come on the Educated Homebuyer Live and talk to us about how this impacts your constituents here? Because I am dead serious. They're talking now. We have the debate between Republicans and Democrats about we need to extend the temporary increases to subsidies for Obamacare, which it's easy to say, hey, we're going to have people who don't have health care and they need it. Well, we already had subsidies. We increased them temporarily for a pandemic that is long since over. You have not solved the problem. We've made home medical care more expensive than it ever has been. But the answer is we need to extend subsidies more and grow this debt right here. So they need to get serious about the issues that we're facing and stop trying to divide the people at home and tell them that the other side's the problem. We're not. They're all the same. That's what they're all brothers and sisters. They're all the same. This is the 10-year, Jeb, but this is a weekly chart. You pulled up the weekly earlier. I said, I like that. Let's share the weekly with them. It's nice and simple. So on the weekly, we had a really nice downtrend going here. If we look, what is that? Almost 6 months worth of downtrend. And as of today, we are up and out the top of that channel. But the red line there tells us we do have some resistance on the way up for that 10-year yield. Hopefully that holds and we can push down in that green channel here over the next week. You guys don't care anything about that. All you want to know about is what are interest rates if I need a mortgage today. So this shows down 0.05 over the day, up 0.07 over a week. So 6.30 quoted a borrower today, a well-qualified borrower, 20% down, 800 credit score at 6.125. So your mileage may vary depending on your qualifications. FHA and VA, these are actually showing really high, the 5.92, 575 plus or minus, depending again on your qualifications, your credit score, and what exactly you're doing, and if you're trying to get some lender credits.
All right, good stuff. So let's do this. This is the time in the show where we start answering questions live. So if you have questions, make sure you put them in the chat. For those of you who don't know, we're actually streaming on Instagram as well. Our main platform here is YouTube. But if you're on Instagram and you're watching this and you have questions, put them in there and I will answer them. Josh and I will answer them. It could be about real estate, it could be about mortgage, it could be about anything. Really? We'll answer anything, Josh. I mean, we've been doing this for 5 years at this point. I mean, these people know everything.
We're good at politics.
We will not be addressing politics on here. But with that, so we got some comments. Just to kind of get out of the way. A couple people in here, just talking about rates need to be below 3% to improve affordability. Will we ever see it again? So the idea is no, you don't need to see rates below 3% to improve affordability. Affordability is improving if rates stay at 6%, as long as wages continue to increase and home prices move sideways, right? So there's three things that impact affordability. And it's those three things, right? It's interest rates, it's home prices, it's wages. So you can have any three of them working or going up while the other two stay stagnant or come down and affordability improves. Now, it may not improve the way you want it to improve, but there's a high likelihood that you don't see that sort of affordability again for probably a very long time. I mean, the likelihood of seeing a 3% interest rate is probably far gone without some sort of massive economic issues out there where they would have to stimulate. And I don't foresee that happening anytime soon.
The paradox, Jeb, is the reason why home prices are so high is they were too affordable for too long because the interest rates were overstimulated. So everyone, we want your questions, even when they start with false premises. So when you throw something out, rates need to be below 3% to improve affordability. That one, as Jeb just did, is really, really easy to disprove. 5% improves affordability, just like 6 was better than 7 and 4 would be better than 5. But interest rates are not the only thing that impact affordability. We see 3 to 4% wage inflation every year. And we just went through home prices. We looked at that chart. Home prices have gotten more expensive over time. That being said, affordability, I mean, rates are only down from what, 7.25 at the peak, Jeb, somewhere around that, to 6.25-ish right now with the M&D data.
And the chart you posted a moment ago, we're basically 0.46 lower than we were this time last year. So a year ago, we were sitting at almost 6.7% or so on interest rates. So 6.25 is a hell of a decent change there.
So rates are nowhere near 3%, but affordability has improved. If you look at the chart of affordability, it's improved a lot. It still sucks. It's still at record lows. So affordability improves or affordability works for me. There are more people. The fact that we talk about mortgage applications being up 15, 20% year over year, that means for 15 to 20% of people, the affordability works now where it didn't work last year. So affordability is improving. It's not good. It's not where it wants to, we want it to be, where we need it to be. And some of these other comments here, Jeb, point things out super clearly. Momo gets money, which I like that. I want Momo to bring some money over here to me once he or she gets it. But 5% will unlock the market. 3% is a pipe dream. Well, 3% was a function of government intervention. We don't want government intervention because that means there's a problem going on. We've seen 4% without government intervention. And I think you'd probably see high threes without government intervention. So that could happen, but that generally means we have a slow economy that we're trying to stimulate. So what's the right number? 4.5, 5, 5.25, the Goldilocks number. Because that would, and he says 5% would unlock the market. I agree. We would, if 7 to 6 took us up 15 to 20% in applications, it's probably another 30 or 40% if we got to 5%, even though affordability would still be historically low.
All right, Josh, a question here. I'm just going to summarize it. Can you do a cash out refinance where you actually have to bring in money? In the sense that you're paying off debts, you're paying off other things in there, and the cash out isn't necessarily coming in your pocket. It's going towards different line items, if you will.
They are not common, but absolutely. So you'll here's kind of the overview of a situation where it would make sense for a borrower. I have some equity in my home. I can only get good terms up to 80% cash out. So 80% allows me to pay off almost all of my debt. But say I have another $25,000 or $30,000 of debt, and if I don't pay that off, I don't qualify. Debt to income ratio is too high. So I take some savings, I take some money out of a 401k, I do whatever to pay that off so I can get the cash out loan to massively lower my debt. And hopefully it's not, we don't want to use the house like an ATM. We don't want to give up home equity that we've hard earned over time with principal reduction, time in the home and discipline. But what I often see, a situation like that, something happened. Spouse leaves, spouse gets sick or dies, bad things happen. You know, we all want the best in life, but bad things occasionally happen. And sometimes a restructure like that is a get out of jail free card. Hopefully it's not because we went crazy with our spending and went to Vegas and spent a little too much money.
All right, Josh. So, Josh, more of a statement here than anything else, but just says, since the economy has been losing jobs all year, shouldn't the government prioritize job creation? If you have no job, income, rates, affordability, housing, et cetera, doesn't matter. So we talk about stable employment, Josh. We talked about it at the beginning of the show. We talk about price stability, right? So price stability is essentially the goal is to get inflation down to target of somewhere around 2%. At the moment, what's unemployment sitting at 4.3, 4.4, somewhere in that ballpark? Is that where we are?
4.3, I want to say.
Yeah, somewhere in that ballpark. So thoughts on losing jobs and the idea of trying to create more jobs. We saw the latest JOLTS number, job openings were higher than expected. So we got a lot of job openings, 7 million plus job openings or something out there.
4.4 in September, and it was like 7.6 job openings, and they were expecting 7.2, 7.3. So that was a little bit of the reason why rates were worse yesterday.
Yep.
More job openings is a bad sign because it means power to the employee to say, hey, there's lots of job openings. If you want me to come and take yours, fill your position, I need more money to do that. So again, just different things in terms of the premises here. Shouldn't the government be prioritizing job creation? What can the government do to create jobs? They can do things like the New Deal, and they issue a bunch more Treasury debt and start these infrastructure programs and create construction jobs. But realistically, on a day-to-day basis, what can they do? They can stimulate the economy by lowering interest rates and making it easier for businesses to finance new projects and keep their employees on. So today, cutting with the unemployment rate pushing up towards 3% tells you of that dual mandate, we are prioritizing job creation. That they told you loudly and clearly with their actions today. That's 100% what they're doing. We're not going to worry about inflation right now. We're worried about making sure that we don't lose any more jobs.
All right, good stuff. So this is a good question here. So I can't tell the name from here. Josh, was it Brisn? I can't. I need your screen. I need your screen.
Briztins 981.
There you go.
Breeze
Yeah, that's why I can't read it. I'm looking in Elk Grove as a first-time home buyer in the $500 to $550,000 price range, conventional loan. How do you determine if you're being too picky or have the fear of missing out? Non-fixer up, sell quick, but I feel like prices will drop a bit more? Question mark. So here's what I would say. How do you determine whether you're being too picky or not?
Hey, Jeb, can I just interject here for the
Yeah, go
context? Because
for
a
it.
lot of people don't know what in the heck Elk Grove is. Elk Grove is
Sacramento, right?
near
Yeah,
Sacramento here in California. Good market. It is a market that has been declining, not
sure.
dropping, not falling off a cliff.
Yep.
We have a friend of yours, Jeb, that you referred to me. I did the loan for. He bought about a year and a half ago before getting an awesome job in Colorado and had to move and sell his house. And they had to take a haircut on it. And it was a bitchin' house, like right in this price range. It had been flipped, but flipped high-end designer finishes, nice stuff. And they ended up having to take a little haircut on it. So just some context for those of you watching, if maybe that helps what Jeb's going to say.
Yeah, what I would say for one, having an agent in that market that understands that market for one and can kind of give you an idea of what's happening with prices, somebody that's actually putting in offers and has listings and can give you again additional context is key, especially because Josh and I are in Southern California. It's hard to tell you, if you're being picky or what have you in that price range. What I would also say is that if homes are selling quickly in the price range that you're in and your offers aren't getting accepted, it's probably not being picky. I mean, those properties are probably in higher demand. Now, what I will say is that in a lot of markets right now, inventory is probably at the lowest level it's going to be for the next probably, I mean, let's say this moves into January, February. Those are the lowest months of inventory you're going to see for probably the next 10 months or so, right? And so you're going to get more options as the spring starts to come around. So I would say be patient if you're not seeing what you want. But if you're seeing properties you like and you're putting in offers and they just aren't getting accepted because you're either lowballing the offers and the seller's not accepting them and they're taking something higher, or some multiple offer situation, then that's a whole different story. So I realize I didn't answer your question directly, but I would say talk to a pro in that market. I have a really good agent in Sacramento. Helped a lot of people. In fact, helped Jensen, the guy that Josh was talking about earlier, about buy and sell that house. So if you need somebody up there that knows the market, reach out, and I'm happy to connect you. So.
Jeb, at risk of sounding like a broken record, we have a really good example here. They're saying, hey, I'm in a declining market, not falling off a cliff, but a declining market, and I'm having a hard time getting offers accepted. People, well, how is that possible? Turnkey homes for a picky borrower, a picky buyer who wants something specific in the home. Those median priced homes that are fixed up and are nice, that's where the demand is going. If you want a fixer upper, you're generally going to have less trouble. And the crazy thing was, Jeb, when the market was super hot in 2020 and 2021, people were having to pay through the nose for fixers because people were like, I'll take anything. Right now, that's where the buyers are going, the turnkey stuff. Because if I have 3 to 5% or 3.5% down for an FHA, I probably don't have a whole lot more money to go in and fix it. So I want this thing to be pretty darn nice when I walk in the front door.
No, absolutely. Absolutely. And again, if there's not a lot of options, just be patient. There will be more inventory coming. It's the lull of the year, if you will. And things will continue to improve. I think both on rates and probably inventory. All right.
Momo came back with a comment. Let's just throw it
Yep.
out here. It says, I'm using house hacking to start my portfolio. So that should mitigate my DTI as I go for my second and third deals. Currently house hacking a 4-unit. 4-unit house hacking, a lot of people call it that. It's really just investing. You have a property that nicely pays for itself, or the rent from the other 3 units offsets your own rent. And when you leave and move on to the other, all of that should offset the payment. We have a listener to the show, Jeb. Congratulations to Freddie and his fiance, Arlene. For those of you who've been around for a long time, Freddie, you're not going to be happy when you hear Freddie's story. Freddie bought in the middle of 2020 FHA. Within 7 months, it appraised for enough that we were able to do a conventional loan and get rid of his mortgage insurance at a significantly lower rate than his FHA. And he's been house hacking that. His brother and 2 buddies live there and rent rooms. So he's had very low rent, very low payment, very low mortgage. And now he and his fiance bought a very nice house and he's renting that property out. So in that situation, it makes it difficult because most people, when you're house hacking, just remember this. If you have a single family Or if you even have this 4-unit, you want to make sure you're declaring that income on your taxes. It's generally not going to be a profit, even if you're house hacking. Maybe a little,
Right.
higher. That house was probably about a 4,500 monthly rent, and I think he was getting 5,000 by renting each of the 4 bedrooms. So you may have a little bit additional profit, but you need to show it on your taxes if we're going to use it moving forward. There's some workarounds. We probably should do an entire episode on house hacking. The house hacking stuff definitely is easier when it's units versus a single family where you're renting bedrooms.
Yeah. We can definitely talk about house hacking. I think we have to some degree, Josh. Yeah. In California, high cost areas, it's not easy.
It's hard.
It's very hard. In some other markets out there, it's a lot easier to do, but we could definitely spend some time and talk about it on a future episode, if you will. So pastor, we got a pastor on here. Pastor James says, thoughts on listing a home, rent to own. We are moving out of our primary residence and thinking of taking advantage of the tax rule of living in your home out of 5 years and then selling it. So Josh, my history with rent to owns isn't great. Not because I've done one or seen, I've just never seen them be successful in many ways. So, typically in an appreciating market, nobody does a rent to own, because why would you? Because basically you're determining the price now for what somebody's going to pay in whatever specified time you determine, right? In a declining market, they make more sense for you as the seller to do them. And, the only time, the only thing with that is that you need to have a backup plan if things go sideways with that property, if you will, just because I've seen a lot of these people go rent to own and then not be in a position to buy them at the end of whatever term you specified. And now you've got essentially a renter in the property that, depending on where you're located, if you're in California, with just cause, it may be damn near impossible to get those people out of that property. So you could end up owning it longer than you had intended initially, and then you impact your capital gains tax. So there's a lot of little nuances there, and I don't want to scare you away from doing it, but you need to think through this whole thing, because it's not always as cut and dry as just saying, hey, this is what I'm going to do, and it's all going to work out.
I got a couple thoughts, a couple things here to add. When I hear this, it's great where you went, because my mind was going a different area, and I think they're both good insights here. When I hear we're thinking of taking advantage of the rule of living in your home 2 out of 5 and then selling it, why are we waiting? Are you in an area that you expect appreciation? Unless you've lived in the home less than 2, you're not going to have 2 years over the next few years, because you didn't live in it for 2. So you can take it today if you've lived in it for 2 years. So as Jeb said, there's complications to the rent to own. And are we expecting appreciation? How likely is it that it actually pays off and works out that way, and you close it? And those are my thoughts on it. Like, why are we holding? Most people aren't cut out to be landlords. So just be realistic. If that's not your MO, if you don't have a really solid reason, I mean, doing rent to own doesn't make it eligible for the 2 out of 5. You should already have been there. So if you want to sell, just sell the property. But Jeb, we have a listener to the show who's going to be closing next Monday. All of the examples tonight, Jeb, are people who were closing homes for in December, which is not the prime month for closing purchases. But Chris owned her home in Chicago. She got relocated to Tucson for work. And we got the lease agreement for her departing residence, and it says rent to own. And I haven't gone through the super details with it yet, but they're 3 months into that. They have 9 months, and then they have to exercise, and she can either choose to extend or go, hey, you guys are out, and I'm going to keep the rent. Because generally what happens is you get excess rent. There's some excess rent collected, and it goes to a side account. You have to show that it's above market rents, and that goes towards your purchase. And if you don't purchase, then that's the benefit to the seller. They get to keep this excess rent because you didn't exercise your option.
Yeah, good stuff. And just kind of going back to Pastor James' comment there, let's just explain what capital gains is. So you got to live in the property 2 of the last 5 years, right? So in theory, based on what you're telling me here, you've lived in it 2 years, and you're in a position now to sell it and take the capital gains exemption, $250,000 for an individual, $500,000 for a couple, somebody that's married, partners, whatever, married. So in theory, if you've lived in it 2 of the last 5, you could actually rent it out for the next 3 years and still sell that property, as long as you haven't done another one within that 2-year period. and reap the capital gains rewards on that particular property. Now, once you go over the 3 years in one day, then you've essentially lost that exemption, if you will. So that's where you got to be careful. So, like Josh said, unless you think that property is going to continue appreciating, and even if you think that, you're selling it, when you're selling it now, you're essentially selling it at today's price. You're not selling it at a future price in most cases on a rent to own. So there's a lot going on there. I would say talk to somebody that if you're going to list it and go that route, talk to somebody that understands it and can help guide you through that process. I think it'll be helpful in helping you make informed decisions. Let's see.
Momo has a follow-up. I like it. We're having a conversation with Momo, and I think he's been here before and given us some feedback. It's from Redondo. Moved to Oklahoma City to invest. Working remotely. Happy with my decision. Only going to return to LA if I have a portfolio of 3 or 4 multifamilies. Oklahoma is a very hot market for investing because the rents are relatively high and the prices are relatively low. So it works out very well cash flow wise. Indiana market also very popular. You were talking, Jeb, earlier about Arkansas. You and I have both seen some amazing properties in Arkansas, cash flow wise. You're not going to get as much appreciation that you get in the coastal areas, but cash flow wise, it can be really good. We did, Jeb, an entire episode on moving to a lower cost of living area. And many people like Momo piped in and said, best decision I ever made. Own a really nice property, far nicer. Arkansas is on my mind because we have another listener to the show, James, who hopefully is going to be under contract here in the next 24 hours buying in Arkansas. He rents a home here in Fullerton. It's probably a $1.2 to $1.5 million home, $5,000 or $6,000 a month. He's going to own a home literally 5 times nicer in Arkansas for $500,000 with a much lower owning payment than renting. So I'm not saying it's the right decision for everyone. There are reasons, whether it's family, whether it's a job, certain things that keep you, the weather.
I golfed today, Josh. I realize it's a Wednesday, but I went golf. It was 77 degrees. Wearing shorts. I mean, let's be honest. Like, that's why we're here. Like,
yes,
you can't do that everywhere.
Yes.
But anyway, yes. So
I golfed on Saturday with the gentleman from Kansas City in 78-degree weather in Rancho Mirage, and he said, "We don't care if it's 40 degrees and it's not raining. We will get out there and golf. You put a couple extra gloves on, wear a thicker jacket, you just do it."
A bunch of pansies out here, and we are. Rightfully so. I've lived in other places, and yes, we out here have become accustomed to certain weather, and when we don't get it, we like to bitch about it. And I'm at the top of that list. I'm the number one complainer when the weather's not nice. So, but anyhow,
either hot or cold. Jeb has a range about this high that he's
I want it to be perfect every day.
Other than that, he will complain.
That's why I came here. Anyway, now is a good time to put in questions if you have them. Been going for just over 40 minutes here. We do this every Wednesday, 5 p.m. Pacific Standard Time, typically for an hour at least. Josh, this is episode. We need to look to see how many of these we've actually done.
But
I think this is probably episode 230 or 250, somewhere in that ballpark. I mean, we're going on 4 or 5 years.
I'll take the over. I think it's more than 250
on lives.
On lives.
Oof, that's a big number. I'll have to look it up.
It's definitely well north of 200. I think a little north of 250.
And actually, if you're listening in the chat right now, let us know how long you've been watching the show.
Have you listened to all 250 episodes, including the 2-hour episodes? There's going to be a quiz.
No, just let us know how long you've been watching. It'd be interesting to see what the longest person actually on here, and how long they've been along. I know we've got some people on here that have been here a couple years for sure. But it's funny when people have bought houses and then they still come back and still are here. All right. Question here from Cristiano. What do you?
You're trying to make meth.
Yeah, I was trying to. Yeah, here where we go, dude. I tell you, need the other screen. Why do you guys? What is your take on the high end luxury market for the end of 26, 27? Yeah, I know I'm reaching.
Before you answer, Jeb, I want to throw something out. When you say high end luxury in our neck of the woods, high end luxury is like $25 to $40 million. So I mean, there's like that's high end luxury. Luxury is 3, 4, 5, 7 million, but high end's like $40, $50 million. I don't.
Yeah, and it's less impacted by truly what's going on out there. I mean, those are people buying trophy properties at that point, right? It's less impacted by what's happening in the world and more impacting on people just wanting a certain thing for whatever reason. But let's just talk luxury in general, not necessarily high-end luxury. High-end luxury is more impacted by what's happening in the stock market, by what's happening with capital and just in general, right? Because a lot of these people are business owners. And so typically this is a slower time of the year. I have a buddy that sells high-end luxury 20 million plus here in Orange County. And, I asked him probably a month ago, and he said it's slow. It's a slow time. And I said, is it seasonality? Is it what's happening politically? Is it rate? He's like, honestly, I don't know. He's like, it's probably a little bit of everything, but until we have a little bit of certainty in the market, because again, there's a lot of uncertainty happening out there with so many different things, and people aren't willing to spend big dollars in real estate until they kind of have an idea of where things are headed. So I think depending on what happens with interest rates, when we just talk about general luxury, say 3 million to say 5 million, if interest rates stay where they are now, come down a little bit, then I think that luxury probably does well, continues to sell and move. If interest rates were to stay high, that's a problem. Just in general, because obviously less people buying it, less people able to buy it, right? But I think as we move into spring, you're going to see more inventory in that market. But most of those people that are selling that type of real estate are also buying in that same price range. So it's kind of a 1-1 trade-off. But I think it's going to continue to move. I think 2026 will be a better real estate market than 2025 in a lot of different ways. And I think with that, luxury is going to benefit just like everything else. So that's my 2 cents.
He follows up, says, I thought most were cash buyers. Generally not. I mean, they will get much smaller loans oftentimes. But the broker owner of the brokerage that I work under, his average loan is $2 million. Average purchase price is probably closer to 4. So a lot of people want to keep their capital working and see the cost of a mortgage as relatively low. It's just a allocation of assets issue.
Good stuff. We got some people on here that's been watching since 22.
Dixieland here since 2020, bro. You better go back in time.
Oh, there we go. Momo gets money. Another one here says he remembers the Crash Bros getting mad at me back in 2022.
It's funny how they disappeared. Like after 2 years, they were going to come back next year and tell us when home prices crash and what idiots we were, but they're all gone, including the guy who lived in his basement and just would get mad every week by posting.
I think we ended up banning that clown just because it was too much.
He was so offended that we told him he lived in his mom's basement and didn't know as much about economics as he thought.
Too good. You got some 2023s in here. All right, let's get some questions here. I saw a question here.
This is actually a good one. It's a long one. So I'll throw the first one up and then we'll get it off your face as quick as we can.
Yep.
2 weeks away from closing on a 6% FHA. I don't understand how people tell me that it's too high for a rate for FHA when this is the second lender with the same rate. For context, it's a new construction, $30,000 off original price with $10,000 towards closing costs. Both scores are in the 680 and hers are 700. Am I doing the right thing with the interest rate right now, the way the market is in Riverside, California, Winchester to be exact? That rate is too high. It just is. So if you're with the builder and the only way you get the $10,000 is to use their lender, it's not egregiously high. It's not massively high, but it's too high. So whoever you double checked it with, you may have checked with a mortgage bank. The retail mortgage banks are famous for using their FHA and VA pricing to subsidize their conventional loans. So you probably just double checked it with the wrong person. But the reality of it there does come down to, do I have to take it? Do I have to take those crappy terms to be able to get the big concession there of the 10,000? The 30,000 coming off the price shouldn't really matter, but the 10,000 is probably tied to using their lender. And in that case, Winchester, you're probably in the 500,000 price range, 5 to 650, most likely. So you're talking almost 2 points. So if someone gives you 2 points, you can just say, I'll do this no cost, roughly. And then if and when rates cooperate and get down to 5%, I'll do an FHA streamline. So not an issue, not a problem from that end. ODB wants in.
Oh, too good. I'm reading some of Willing's comments here. He talks about the time that you claimed that Ben Carson was dead.
Who was it that actually was dead? That I was
I
confusing
forget, but that was
men
good. Just
Willing will
some of the,
remember. There, I was right. Someone was dead. I just had the wrong politician when I was saying who was dead. Dr. Ben is still with us.
You started a rumor out there that spread around the internet.
Yeah. It went viral.
That's too good. Let's see what we got here. Any more questions? Got a couple people on Instagram just saying hello. We had John telling us great show. So thanks for being here, John. If you have questions, whether you're on Instagram, YouTube, let us know. Happy to address them. I got about 10 more minutes here on the live. The goal here, again, is to educate, empower, so that you guys can buy right, borrow smart, and build wealth through home ownership, right? We've been, as I mentioned a moment ago, been doing the show for 5 years almost, every Wednesday, and helped hundreds of you guys. Would love to help more of you. In fact, if you want to get in touch with Josh or myself, you can use that link scrolling in the bottom of the screen there, jebsmith.net/start. It'll get you in touch with Josh and the team. If you're local to Orange County, can definitely help you in the home buying process. If you're not, I can definitely refer you to somebody across the United States. I think I made like 47 or something referrals across the U.S. this year. Josh, a lot of referrals nationwide. So happy to put you in touch with somebody. Yep.
Jeb and I were just talking before the show.
Gemini. Is that Gemini?
Gemini. It's Jebini. We should start our own GPT and call it Jebini. Jeb and I were discussing, and our objective for next year is to help 100 listeners of the podcast and viewers of Jeb's channel either buy or refinance. So if you want to be one of those people in our 2026 list of 100, we're gonna have a collage next December, Jeb. We're gonna put a collage of all 100 of them. It'll be like a Brady Bunch wall we'll put up here.
We should do that with the people we helped this year.
I will go through and see how many pictures I have. I do have a chunk of them, but Jose 925, not to be confused with another Jose. I just refinanced from 6.99 to 6.125, $400 in savings per month. Thoughts? Did I pull the trigger too soon? The only context we don't have here is how much did you pay for it in total cost, not just points, not just box A, but everything on the left side of the loan estimate, the closing disclosure. So box D, which is the total of A through C, and then box E, those are the costs of the loan. So if you had $3,000 of cost and you're saving $400 a month, 7.5 months from now, you're to the good. So the question just becomes, was there another opportunity to get it lower in the next 7.5 months? There may be, but there's no guarantee. I would never begrudge anyone putting aside $400 of savings per month. Hopefully the lender that you were working with walked you through that. Some of that is in savings from extending back out to 30 years and gave you the option of staying on track. Probably 50% of our clients, if they've been in the home for more than a year, choose a custom loan term to stick on track to get that home paid off so they're building equity quicker.
All right. $4,000 cost, Josh.
4,000. So 10 months. It's a 10-month break even. So did you pull the trigger too soon? No, because right now, next month, you're going to have $400 more a month for as long as you have that loan. Most likely you weren't going to refinance again in the next 6 months. So a 10-month break even on that is perfectly reasonable. So again, there's no right or wrong answer. Probably the biggest wrong answer I see is people turning up their nose at $400 and saying, I'm just going to post up and wait it out. And then they go and like 8 months later, they get to save $450 a month, but they never acknowledge that they left $3,200 of savings on the table by not doing it earlier.
All right. No, for sure. So Joyce asked if we're going, how the home buying workshop went yesterday. So last night, for those of you who don't know, we did a 90-minute home buyer workshop where we basically went through the entire home buying process from A to Z. How many people do we have on that, Josh? I forget. I don't remember.
Close to 100, and they're early birds. Close to 100 early birds. We generally do this in January. Everyone gets their New Year's resolution. They're going to buy a home. We said, you know what? Some people are preppers and they're going to prep in December. And we had close to 100 of them on last night.
Well, that's awesome. So the question is, are we going to post that anywhere? And at the moment, we don't know. We haven't decided whether or not we're going to post it because we're doing another one in January. Essentially the same format, same everything. It's just going to be in January for those that aren't necessarily early birds that get on a little later start. The people that don't wake up at 5 to go to the gym. We're talking to the people that wake up at like
7 a.m.ers.
No, we're going to the 10
That's the spring. Those are the spring people. The January, they're still the 7 to 8 a.m. crew.
All right. So we'll figure it out. But if we do, I will let you guys know here if we do decide to post it somewhere. But for now, we're just going to keep it off air and only give it to those who registered and actually went through the process, because there's a couple things in there, some incentives for those that joined, and it's only right that those people actually get that at this time because they did what we asked. So anyhow, appreciate you asking, Joyce. But if when we have the new date, we'll post it in here, and hopefully you can make that one.
Jeb,
All right.
We have a question that I don't like. You just threw it up there. So
all right. I looked at a new build, 524,000 that I like, and toured with the site manager. I have a buyer's agent, but he doesn't want to look at it because he doesn't get commission. Is it there a timeline or indefinite? I'm not sure I understand that part of it.
So is there a timeline on the buyer broker agreement, or is there a timeline in which if you don't put something under contract, you can go back with your agent to the builder? I'm not sure, but those would be the only two
so buyer
timelines I would be
broker
thinking.
agreements in the state of California are for 90 days max. But here's the thing. If you show up to a new build without your agent, more often than not, that new build will not pay your agent's commission. That's just part of their deal. Now, if you, on the other hand, have
How do they know, Jeb? How do they know I've been there before?
Because there's a sign-in sheet. They go old school, baby. You got to sign into these things. Now, here's the caveat.
Use a pseudonym.
Exactly. Yeah. When you go in, put a different name on there. But anyhow, the caveat is if you have signed a buyer broker agreement with this agent, and now you go in and the builder is not willing to pay that compensation, in theory, you as a buyer are liable to do that. Now, depending on what happens with you and your agent, they may say, no, you don't worry about it. You may not even have a buyer broker agreement, so it's not worth it. But here's the thing. I would be just like your agent, right? I mean, unfortunately, if we don't have an agreement together and you've decided to buy new construction and new construction is not going to pay me, I side on the side of the new agent. Why would I waste my time and go through that process and do all of that if I'm not going to get compensated for it? So I realize that sounds like I'm being snarky or not doing my job, but the reality is if we don't have some sort of binding agreement, what
happens if he goes and just goes into the new builder and signs the contract and does it all on his own? Is with the buyer's broker agreement, is the agent entitled to compensation? They weren't procuring cause.
It doesn't. Well, it depends on what the agreement entails, right? It depends on if it's an exclusive agreement or non-exclusive agreement, or what type of agreement they have with that broker, and what state you're in. I only know what the one in California looks like. I don't know what other states look like. But that said, they don't have to necessarily find the property for them. So that's on you. But what I will say is that new construction is a different animal. New construction companies, they have their own contracts, they have their own disclosures, they have their own everything. And guess who it protects? The builder. It doesn't protect you as the buyer, right? Here in the state of California, the residential purchase agreement protects the buyer, the seller, the broker, everybody, right? That's there to make sure every party is kind of treated equally, if you will. Whereas the builder's agreements focus solely on the builder. So just make sure if you're going through that, you understand what you're signing, so that, you don't get yourself in trouble. Let's see here. She goes back and says he wouldn't get commission, but I looked at 6 months ago, signed the buyer agent contract last week. I'm not sure I fully understand. So if you signed the buyer agreement with last week, then in theory, yeah, I don't know. You looked at the property 6 months ago and now you signed the agreement. I don't know. It's unless that property was specifically listed in that agreement that it's not part of that compensation, then in theory, I think you're still responsible. But I don't 100% know, because I'm not sure I fully understand what you're asking. All right. Josh,
do you fully understand, Jeb, that Willing remembered episode 169 when we talked about the housing market in Pound Town?
He's going back and listening. It couldn't have been 169 if we're on. He said 256 a minute ago. It wasn't that long ago. That was like
who was asking about the housing market in Pound Town? I forget. That was one of the funnier episodes.
Good old Pound Town. So
Maddie says it's not the cold, it's the humidity in the summer that a Californian can't adapt to. Maddie, are you in Arkansas? Are you in Oklahoma, Indiana? Where are you at?
It's not only the humidity. It's the bugs, it's the flies, it's all of it. I've lived there. I've been through it. And guess what? I don't want to go back. Every time I go back, I'm like, yeah. And I'm not like these finicky, like spiders, that sort of shit doesn't bother me. But bugs, flies, while you're sitting eating outside and you're like doing this the whole time, and like mosquitoes on your ankles. No, there's none here, man. The wind blows, they don't come by. It's great. It's fantastic. Josh, when's the last time you had flies?
Long time.
Yes, there you go. That's why. Anyhow,
My house did almost flood 3 weeks ago, though.
it did. King tides.
Yeah, is that what it was?
I
I
don't
thought
remember.
it was the torrential downpour.
That's what it was, actually.
The
Yeah,
wrath
king
of
tides are
God
just
pouring
basically.
down on us.
All right, guys, we've been in here just wasting enough of your time. We will be back next Wednesday. Until then, buy right, borrow smart, build wealth. Adios.
Amigos.